Well, hello everybody, LA here. This is the weekly report for the August 20th. I got a lot to cover, so I'm going to just kick right into it here. Down on the week, Russell's the one that hit the Hearst. The dollar is perking up, trying to break out. Something to watch. Bonds got a little bit of a lift. Overall, still big gains on the year. Gold and bonds are down. Retrace, is it going to be any different than it has been before? That's a question we're going to have to answer. If we look here at the sector performance, you can see big declines everywhere except for this area right here. What is that? Well, technology is one of them, but durables, utilities, healthcare, safety, right? Rotation again, same thing we've seen over and over and over. There's no real exit. Nobody's leaving. So that question of is it going to be any different? Well, technology's holding it together. You're rotating. Looks pretty much the same, doesn't it? So to follow up on that same question with a graphic, here's a decline, V-shaped recovery, new highs. Same thing here, same thing there. Looks like the same process, doesn't it? But then what if it fails? Well, pulling it out, looking at it, if it were to fail, looking at it differently here, that's a retest regents the second time. If it were to fail on this bounce, in other words, we don't go up and make new highs, that would be something different, right? And that would, at least begin to get our attention. But again, we're still looking here at the daily time frame, so it's going to take a lot more than a daily to do anything. But if we can't go up here and make new highs and we roll back over, the third time down here, you're probably going to break. And then maybe you come down and look for these lows down here. Is that the end of the world? Not at all, right? That's just, a larger drawdown within the bounds of, a market that's up huge on the year. There's plenty of cracks out there. There are always something you can hang your hat on depending on what your frame of mind is and what your bend is. But these were failures here on the NASDAQ last week, right? You got up underneath here the week prior, and then this week you broke it down here. So this retest regen failed. That one failed as well, but here it comes back up. Now, there is a swing point low here. It's kind of overwritten. I'll just clean that so you can see it. The swing point low here, which is this bar, that's the top up there. So got to get over that. If you do, it's new highs. And so that's, something that you can hang your hat on, watch. But if you look at the big cap technology, we thought it broke down on Wednesday. It actually didn't. It came very close. And it's regenerating, right? It's back up above and trying to head up to new highs. Most worrisome index continues to be small caps. I mean, these things have gone nowhere for a very long time. We're talking about pretty much all year. So we had that big move up last year, right up into the beginning of this year, made a top up here, right? And it's been a range ever since. And so it's a full year now ranging in this area. That could be a good thing, right? Because if it's consolidation, right, if this whole thing is consolidation, then the continuation would be another leg like this one you saw here. So, you could view it positively, but if it's distribution, it's the opposite, right? If this starts to break these swing point lows, it becomes a real problem. And so I kind of outlined here what that might look like, these three bars that I've laid in here. So you'd probably break it, get a bounce off of it, and then come back down again. So if we see the Russell start to break down, I think that would really get my attention, especially since this is on a weekly time frame. But that's not going to happen unless the NDX and the S&P probably break down. They're the ones that keep holding this thing up. Which brings me to the ideal sectors and sector weightings, right? Because so much of what's happening is the weightings. I mean, we know that there's bad breath. We've looked at that over and over. We've looked at the qualified trends, etc. They're not improving. They're the same as they have been for a long time. Divergent, showing us that there's problems. The reason we can't break down, though, is because the weighting structure is what it is. And I went back and pulled up the weighting structure using this link here at Bespoke. And if you go back to 2000, right, technology here was about 32% in February of 2000. If you look at the 2007, right, and I'm picking the years where you saw, big declines afterwards. Technology and financials added together was about 35%. So you had 32, 35. And if you look at today, it's here again, right? Although it's actually a little bit different, and we'll show that here in a second. So to go back to the 2000 period, right? There was a warning sign on 2000 where it almost broke two swing point lows right at the turn of the year, right? So you get into April, it comes down, hits them hard, almost breaks them. That was a warning sign. This was kind of your exit. And then this was actually the breakdown right over here where it broke two swing point lows, went to bearish. Continuation and just, crashed down. So the market usually gives you one out. In this case, the out happened to be after a sideways move, not a bearish move. And sometimes that can happen. But this happened here on the XLK. And if you look at the NASDAQ itself, that's exactly what happened too. If you look on the 2007 financials were the lead index, 20%. They topped out back in 2007. July of 2007, we saw a breakdown right here. Late July, you got your out up here, and these things went down from there. And so that was 20% of the index getting hit. Now, because it was only 20%, you needed technology to go too, because it was another 15%, and it didn't go until May, June is the exit on it. It broke in 2008 in Feb when we had the Bear Stearns thing. That was, the signal that something was wrong and this market was probably going to, or at least had the potential to get hit hard. You got your exit here, and then of course it crashed in September of that year. This is today. This is where things are today. I just updated this. These are numbers as of about a month ago. Technology is 27.43%, but I said we're going to talk a little bit about that. Well, communications is really technology as well. Let's put them together. It's 38-39%. These two are the leads. You do have another 36% in these other three, and if they all went and technology and say communications for whatever reason held up, you'd have the same issue. But it's this group, primarily communications and technology, and if you look inside it, it's really four stocks: Google, Facebook, Apple, and Microsoft. They make up 50% of the communications, these two, 44% of the XLK. So what it comes down to is those four, and if you look at those four, Apple, Facebook are brand new highs. Microsoft and Google, they're at highs. Microsoft and Google just hit new highs. That's not breaking down. Unless and until these start to break down, you got to assume this market's going to keep trying to go up. At least the index themselves going to keep trying to go up. And just to drive it home, here's the XLK. You can see how it's hitting new highs. And if you look at the communications, it hasn't even taken a break yet. So the point is even if this market were topping just right here, let's just say it's topping right now, right? It's probably going to be a few months before you even know it. And it brings me to the final thought, which is that of the mean regression. I've talked about this over the years. Essentially what you do is you draw a regression line, and I just went out and found one here at current market valuations. Looked at how they constructed it. It looks fine. This is inflation adjusted. They're using CPI, so that's okay too. It's probably less than inflation actually. But the thing is that if your line is like it shows, where your line's down here, right? if you have to come back to the mean, in other words, this is the mean across all these data points over this period of time. When you get too far above the mean, you typically come back to it. Eventually, right? There's nothing that says you have to do it now. You keep going up farther. But at some point, you're going to come back to this line. It's just, it oscillates between over and below this line, and it always does. And it's done that everywhere you look, right? I mean, the whole point is mathematically that's what it has to do. So mean regression is essentially a tautology that, the farther you move away from the mean, right, especially to the top side, the farther you got to go to get back to it. That's true of the bottom and the top. It's just that on the top side, fear is a very strong motivational force. It's the strongest of the two, greed being the other. And you usually come down a lot faster than you go up. And so, yeah, you will come back to the mean on the downside, but this takes a long time comparatively. When you come down, it's hard and fast. And I suspect this one, when it does happen, will be no different. Looked at a different way, here's the same thing, just putting it on a scale so that you can see it compared to the 2000 tech bubble. You can see we're basically at the same sort of valuation on a market valuation, mean regression valuation. So the point here is the real risk is there. You've always got risk, but sometimes the risk is greater than it is at other times, both in terms of magnitude, in terms of timing. And in my opinion, right now, it's high. Are we going to get an immediate crash? Probably not. But you don't have to get a crash to lose money. Matter of fact, you're probably losing money, or a lot of people are losing money in this market right now. Because this market is undergoing corrections all the time. You just got 4 stocks holding it up. Right? So you don't have to get a crash to lose a decent chunk of change. And my suspicion is that when we do get a crash, though, you're going to lose a lot of change. But we're not there yet. But we could get easily, a 10, 15, 20% pullback if we see those 4 stocks start to come off. Maybe it's going to be regulation. Maybe it's going to be, who knows? I don't know what it's going to be. But if and when they start to come back, this market's going to correct. That's more than likely what will happen. And even with a minor correction in those, you're going to see large corrections in individual stocks. Okay, so bottom line here, no breakdowns in last week's tells. In other words, they all held up. The NDX, NASDAQ, they're nearing new highs again. XLF, KBE, KRE, they're all regenerating now. The S&P itself went up and hit that target on Monday that we talked about last week, 44.74, and then we sold off. As for this week, the target now is just under 45. 44.93 is another ABCD target. And so that is the go-to target for this week. Finally, the dollar. The dollar's trying to break out. And, a lot of times, I watch the dollar because it's important. You kind of got a little double bottom thing going down here. You can do the cup and handle if you're doing all the classical stuff. But essentially, you're at a swing point high. You got to break over this swing point high. If you get over it, you're probably going to come back and retest regen because you got 2 bars over here that both have volume on them. And I'm on the weekly. And so my guess is that you'll get a little bit of a spurt because you'll probably see a lot of short covering that takes place as a result. Right? Because I believe that what you have out here is a large contendere of shorts pressing this thing, have been pressing this thing. So if you get that, and my guess is they are going to get that, they're going to force the shorts to cover here, and that's going to push this thing fast up, and then it's going to come right back down, do the retest regen, and then we'll see if it can actually move up or not. Kind of got a rounding bottom taking place here, right? So I suspect this is going to happen. You've already had signs of strength twice. And so this looks to me like it's a foregone conclusion that we're probably going to see the dollar break higher. What does that mean? Well, that's going to hurt commodities and other things, and I'll get into that in a second. Trading plan. I put on a altcoin. The hard decision, I wanted to put it on 20 points lower. Waited a day and those 20 points were gone. It rallied 20% that quick. So, what can I say? As I wrote in the, please take a look at, if you're going to buy something like this, take a look at the notes on this link here, because these things move and they move fast, and you really don't want to take too big a chunk if you're gonna trade them. And you even have to trade them on a different exchange and a different broker. All right, all that stuff is different. It's the Wild West out there with these guys, but they offer a lot of returns. I think I mentioned, I said it here in the link, Solano is one of the altcoins that I had bought into. I think doubled. It doubled basically in a week. That's crazy. So beware. They can go down, just like you saw Bitcoin, Ethereum, and some of the others lose half their value in a matter of a few weeks. So it is that kind of a market. We're basically 31% invested now. If this dollar breaks out, we're probably going to have to take off the XLB trade. It's going to become dead money. It's already under pressure. I'm probably going to try to take it out anyway this week. And we'll look for something else. 31, 40% max probably right now is as much as I want to be invested. Same principles I mentioned last week still apply. No change there. On the fundamental political side, all the economic data, almost all of it, right, is showing slowing, and it's both in the hard and the soft numbers, PMIs, actual production, consumption, etc. The money supply is not growing, right? World money supply. We see a big thing going on in India with some fiscal spending, but outside of that, we did our 1 trillion here, but only half of that, and it's over 10 years. So outside of India, you're not having a lot of new money flowing into the markets right now. If we get that, then of course these markets will go up again, because you can see the correlation, and you don't have to be a statistician to see the correlation. I mean, it's almost 1-to-1. The correlation coefficient is extremely high. If we look politically, Afghanistan, what a disaster. 20 years, it's unimaginable that we would go invade a country, as we did, with no idea of how to win the war in a country that never has been a place to win anyway. I mean, throughout history, they have been a country that others have bogged down in and lost in. Psychologically, it's just a disaster. I don't know how else to describe it. 20 years, basically nothing, trillions of dollars, and now get humiliated as you're leaving. COVID, Delta, it's whipping up the health officials in another frenzy. All of the, I don't want to go into all that stuff. I try to stay out of the politics of it all, but from an economic standpoint, we see the Asian markets getting hit, not just from this, but also from this. Also China, of course, with their regulations and their distribution of wealth is taking a hit on their technology. European, U.S. markets are starting to feel the effects as well. So the COVID is starting to cause a problem. But in this market, bad news, right, is good news. Because what does that mean? Well, it means the Fed's not going to taper. And so if, in fact, this ends up causing the Fed to not taper, right, so the taper does not happen, and that's a not, then that's good, right? I mean, it's kind of a crazy thing, but that's the way it works. So if we get more free money as a result of that, then we're going to see probably these markets try to work higher. We're seeing some of that already. I just saw the food stamps this past week, I believe, or the week before. I don't remember exactly. I saw some student loan cancellation legislation that passed. Actually, it wasn't legislation. I think it was a stroke of the pen. But, these are small potatoes, right? If you get something like this, the 3.5 trillion human infrastructure, sounds like we're building robots. That will be something that can move the market. This here will just kind of keep us coasting along for a little while. Jackson Hole this week, that's probably the biggest thing, but I suspect it's a non-event. I don't think because of COVID, I don't think this is going to happen yet. And I don't think we're going to be told anything yet. It's probably going to be in the September meeting that we hear something. And finally, that spending limit, they're still going to have to raise that, and that's going to become an issue at some point. All right, last week, pretty much between worst and best, worst and most likely case, kind of ended up in the middle. If I look at this week, I think it's kind of a coin flip. I wouldn't say it's a coin flip, but it's a situation where you're going to go one extreme or the other. Probably going to go up and hit that 45 number up here, or you're just going to dive. I think you could see either of these extreme events. I think this one has a lower probability than this one. And of course, this is my expected probability, but I think we have a lot of risk in this market, and you could get a dive at any point, and you really should be ready for that if it happens. Know what you're going to do if it takes place, folks, because a lot of times it will. All right, I'm running pretty late here. I'm going to leave it at that. Have a great one. Stay safe. I'll see you next time.